The emerging Tesla of China saw a boom in sales. NIO is widening its lineup of luxury electric vehicles, and it could be coming to America. But right now, is NIO stock a purchase? Hello folks, welcome back to the channel. In today's video, we will be talking about NIO stock update, company's capacity and analysis. Before we get into the video, don't forget to drop a like on this video and subscribe to the channel if you haven't already. Make sure that the post notifications are turned on so that you never miss a video from us. Without further ado, let's dive in. As it doubled electric vehicle sales and came back from the verge of bankruptcy, NIO went on a tear in 2020. The EV startup kicked off strongly this new year, launching its first electric sedan and recording a major sales gain in January. According to MarketSmith's chart analysis, shares caused a sell alert in intraday trading on February 18th, dropping more than 8% from a 57.30 cup-shaped buy point first cleared on January 8th. NIO stock is now testing the 50-day, 10-week lines on the back of a 6-day drop, and if shares recover, a possible buying area could appear at that stage. Investors will want to wait for NIO to at least retake its moving average of 21 days, which is now close to the old purchase point of 57.30. If the NIO stock recovers, it will soon have a new base with a purchase point of 67.09. In two main fields, namely battery technology and self-driving applications, NIO appears to be innovating, and this is a major part of the inventory driving narrative. For its EVs, NIO is betting big on modular batteries that can be switched out in a matter of minutes, helping to minimize range anxiety while offering batteries as a service under a subscription scheme. This is impossible though to give the business advantage, as other players can duplicate this easily as well. In reality, China's EV policy promotes the production of battery swapping. EVs priced above RBM 300,000 are only giving subsidies for about $46,000 if they have a swapping option. NIO also unveiled a denser battery pack with a power of 150 kilowatts, up from 100 kilowatts currently. This battery alternative will only be available in late 2022, almost 2 years away, and it is likely that other players operating with conventional battery cell suppliers such as CATL will also have similar capacity batteries by then. During its NIO Day event, the company spent a good deal of time addressing the self-driving technique on its new sedan due in 2022, and a related monthly subscription service. Hardware such as high-resolution cameras, LiDAR sensors, and NVIDIA NVDA plus 0.07% processors, all of which are likely to be open to most other automakers, tended to be more oriented. What really gives businesses an advantage in self-driving, however, is technological consistency and the availability of large quantities of data miles driven to strengthen algorithms. For perspective, as of late April, Tesla 0.8% logged a total of 3 billion autonomous miles, while Google's 0.8% logged around 20 million miles with Waymo. How NIO is going to do on these counts is not obvious. Overall, though NIO is undoubtedly increasing rapidly, creating a brand that is becoming synonymous with Chinese luxury EVs, in our opinion, its valuation looks rich, as we do not yet see a sustainable competitive advantage. NIO currently trades in 2021 sales at roughly 18.6 times consensus, which means that it is priced similarly to expensive Tesla, which solid tech and self-driving capabilities partially justify its valuation. Over the last 2 weeks, Chinese premium electric vehicle producer NIO has seen its stock decline by almost 20%, dropping to levels of around $41 per share despite reporting a solid November delivery figure, with sales more than doubling to 5,291 units year over year. While part of the decrease is likely due to some profit booking after a more than 10 times rally this year, the move of NIO to raise around $2.65 billion via a major secondary share offering also hurt the stock. The offering was priced at about $39 per US depository shares, a market price discount of about $42 as of the close of Friday. That said, in the long run, this should be a net positive for the company. The financing remains at attractive valuations, and there is little dilution of existing shareholders. In addition, the funds could provide a secure cash cushion for the company, with the proceeds likely to be used to finance R&D for new vehicles and autonomous driving technologies and to extend the distribution network of the company. Established in 2014, NIO currently offers 3 premium electric SUVs, the ES8, ES6, and EC6, priced at around $50,000. The company is working on the advancement of self-driving technology and also provides other unique technologies, such as battery as a service, which enables consumers to subscribe instead of paying for car batteries in advance. While the company has scaled up production, it has not come without difficulties, as it's recalled about 5,000 cars last year after several reported fires. Extended range electric vehicles are sold by Li Auto, which is basically EVs that also have a small gasoline engine that can produce extra electrical power for the battery. This eliminates the need for infrastructure for EV charging, which is currently limited in China. With its Li One SUV, priced at about $46,000, the hybrid strategy of the company seems to be paying off, ranking as the top-selling SUV in the new energy vehicle segment in China in September 2020. Gas cell, diesel, and plug-in hybrid vehicles from the new technology segment. XPeng manufactures and sells luxury electric vehicles, including the G3 SUV and the P7 four-door sedan, which, while more affordable, are roughly positioned as competitors to Tesla's Model Y SUV and Model 3 sedan, with the basic version of the G3 starting at about $22,000 after subsidies. In 2019, in terms of sales in China, the G3 SUV was among the top 3 electric SUVs. Although the company started production at the end of 2018, initially through a deal with an existing automaker, production started at its own factory in Guangdong province. Prediction: in 2019, NIO developed approximately 21,000 vehicles, up from around 11,000 vehicles in 2018. This compares with XPeng, which delivered approximately 13,000 vehicles in 2019, and Li Auto, which delivered approximately 1,000 vehicles, given that production only began late last year. Although NIO's deliveries could reach approximately 40,000 units this year, Li Auto and XPeng are likely to deliver about 25,000 vehicles, with the highest growth seen by Li Auto. NIO's revenue stood at $1.1 billion in 2019 compared to approximately $40 million for Li Auto and $330 million for XPeng. This year, NIO's revenues are likely to rise by 95%, while XPeng's revenues are likely to grow by around 120%. As R&D and SG&A related costs remain large compared to sales, all 3 businesses remain profoundly loss-making. In 2019, NIO's net margins were negative 195%. Li Auto's margins were around negative 860%, while XPeng's margins were negative 160%. However, as sales pick up, margins are expected to increase in 2020 sharply. As of October 28, 2020, NIO's market cap stood at about $37 billion, with its stock price growing by about 7 times year to date due to rising investor interest in EV stocks. Li Auto and XPeng, both of which were listed around August in the United States as they tried to capitalize on increasing valuations, have a market cap of approximately $15 billion and $14 billion, respectively. NIO trades at about 15 times estimated 2020 revenues on a relative basis. Li Auto trades at about 12 times, while XPeng trades at about 20 times. Although valuations are undoubtedly wrong, investors are likely to bet that these firms will continue to expand in the domestic market while ultimately playing a larger role in the global EV space, exploiting China's relatively low-cost production and the country's ecosystem of suppliers of batteries and automotive parts. Of the 3 firms, given its marginally longer track record, higher sales, and technological investments such as battery swaps and self-driving, NIO could be the safer bet. Given its rapid growth, led by the uptake of the hybrid powertrains and the reasonably attractive valuation of about 12 times 2020 revenues, Li Auto also looks attractive. From a fundamental viewpoint, after debt and liquidity worries slam shares, NIO's financial situation is improving. Although delivering big top-line growth, NIO pairs losses. The outlook seems robust for NIO's revenue and total EV sales. NIO's expected expansion in Europe promises more routes for development after successful sales in China. Major Wall Street companies also regard its advances in batteries positively. NIO can become as much a battery game as an EV stock, similar to Tesla and China's BYD. But as legacy automotive and tech companies ramp up or get into the game, the EV wars are heating up. The white-hot China EV stock staged a quick breakout in early January from a technical perspective, but made choppy progress thereafter. A 57.30 buy point has been undercut by NIO stocks again, and a sell signal is now flickering. And with that, it's time to end the video. We hope this session was informative. Do let us know in the comments section below. Subscribe for more content just like this one and share it with your friends. Also, don't forget to smash that like button and press the bell icon to get notified about our new videos. Until then, fellas,